Welcome to our Raymond James Limited investment strategy update. Last session, we talked about where's the bottom of the market, and since then, we have experienced a rebound. What does that mean? What's next? With us today is Jason Castelli, Vice President, Head of Investment Strategy, and Robert Mark, Portfolio Manager, Research and Strategy. Jason, the market has experienced a strong rebound since March 23rd. Sentiment has shifted from complete fear to FOMO, fear of missing out. How should we be thinking about the recent rally and FOMO?
Well, it is quite amazing that we've had this complete shift in a matter of 2 weeks. Talking to some clients, they wanted to get it all out of the market in March, and now the fear of missing out on the new bull market has now arrived. So maybe let's just put the rally into context. We've had some positive developments on the health front. So we've seen some curve flattening in the US and in Europe. We're starting to see some of the economies trying to open. Right now, it looks like the US economy could open mid-May, mid to late May. So that's a positive thing to be thinking about, and the markets are picking up on that. Just looking at China, we've seen coal demand has been increasing, passenger traffic has been increasing. That tells us that they are coming out of this and their economy is starting to rebound, and they are the second largest economy in the world. The other factor is the stimulus. We've seen a record amount of stimulus from the Federal Reserve, from the US government, from governments all around the world. The Federal Reserve has an open-ended quantitative easing program, which basically allows them to buy assets on an open-ended basis. That's generally positive for risk assets. From one of the lessons from the financial crisis is when the Federal Reserve is easing, that's generally good for stock prices. So we've seen a lot of these positive things feeding into this 30% market rebound. Another thing is the technicals. We're just pointing to a market that was very deeply oversold, and markets are like elastic bands. You spread it out this way, it's going to snap back very quickly. So we'll see. We have a 30% rally off of the March 23rd low. We've retraced about 50% of the sell-off that we've seen in the market. And now people are talking about the fear of missing out. But we have to put this in the context of asset allocation. So the fear of missing out shouldn't be a fear if we have a proper asset allocation. We're sticking to our investment goals and we're staying invested. So if you took a client that had a 70% allocation to equities, 20% to bonds, and 10% to cash, there's no fear of missing out. You still have a 70% allocation to equities. Your cash positions might be high, which is something we've been recommending for the past year, but it doesn't mean you're missing out on the rally that we've seen since March 23rd. And as we've been saying for a number of weeks now, we think the bottoming process will take time. Now, we think, I'll get into this in a moment, but if clients that have significant amounts of cash, say if they're all 100% equities, 100% cash, which we would never recommend, yeah, we should be thinking about putting some money in the market today. Breaking that up into tranches will help not only take some of the emotion out of putting cash to work in the market, but also the dollar cost averaging is also a helpful element. So the fear of missing out is really an emotional element. And so maybe I'll just turn to some of the facts that we know. We know that this is the first time we've ever tried to shut down the global economy willingly. And we know that we are going to enter a recession. And so if we look at historical examples of when the US enters a recession or a global economy enters a recession, typically you see bear markets lasting about 18 months on average, and a typical fall in the equity market is about 43%. And it takes about 4 years before you get back to the high point in the equity market. So there's time for us to put cash back to work into the market. And from our view, we think there's a bottoming process that will take time over the next couple of quarters. So if this is the V-shaped recovery that a lot of people have been talking about, this will be the first in history. And so I'm not willing to say that I'm not going to go against history. I'm going to use past examples of what happens when we enter recession and what happens to equity markets as our guideposts. As we move through this process, you could think about perhaps you've missed the first 20% or 30% move in a bull market. However, bull markets are extended, and I'll just share a chart with you. So this is a chart of the TSX over a number of decades. The green bars are bull market rallies, and the red line is corrections in the market. So you can see there's a lot more green on that screen than there is red. Another thing you can also notice is that the green lines are extended and they last longer. So bull markets tend to last for a long period of time, and bear markets tend to be short and quick. And so we could, if this is a V-shaped recovery, we could have missed the first 20, 30%, but it's the next 100% that we should be focused on. And there's gonna be plenty of buying opportunities over the next quarter, 2 quarters, 3 quarters that will reveal themselves. And as the buying process reveals itself and equities become more attractive, we will be putting cash to work in the market. I just want to stress the fact that bull markets are long, and there shouldn't be any fear of missing out because you missed the first 20 or 30% of a market rally, because bull markets are extended and they can last for a very long time.
Right, and so it really focuses on the importance of staying invested. And as much
Absolutely.
as I think green is good and red is bad, I would actually say red is good, because red does create the buying opportunities so that there's even more upside in the green. So as we talk about how staying invested is important, I'm going to turn it over to Rob. Rob, where should we invest? What equities have been performing the best during this 2020 downturn?
Thanks, Sybil. Yeah, so we've put out a couple of pieces over the last couple of weeks talking about process, tiering, and where we think the growth in markets will play out. So we did that through the lens of dividend safety and dividend growth. And we talked about a tier 1 being more like the necessities, and companies that provide the necessities of life, plus businesses that will win in a post-COVID world. So that's stuff like consumer staples, healthcare, utilities, technology more on the software and e-commerce side of things, and then telecom and gold. And there you have it in the slide there. Our second tier, and again, as Jason said, these processes take time, and we're still short on information. So, without a lot of information, we're happy to invest in tier 1, because we know that these are businesses that are going to be the least effective, and I'll show you in a bit. I'll show you how that even plays out in the market. But our tier 2 is basically, as we get more information. So tier 1 is focused on safety, high conviction. Tier 2 is really when we get a greater sense of where we are, how long the duration is, what the actual numbers are that we're playing with. Then we're willing to take on a bit more risk and look at companies that are necessary to restart the economy. So that would be your banks and insurance companies, infrastructure like pipelines and railroads. On the technology side, then you start getting into the hardware, some REITs, and some select discretionary industrials. I'll leave for today. I'll leave the tier 3 aside, because I think that's the most at risk, and we think, and there, even in a recovery, we're not so sure how those companies will react. But as we look at this next slide, this is what I did here was just go back to the beginning of the year and look at the S&P 500 and the TSX and see what companies had a positive return for the year. And so there was about 57 stocks in the S&P and 30 odd in the TSX. And lo and behold, the sectors that we see with the most, so this is just by the number of stocks within each sector that had positive returns, it matches very closely to what we would expect. Healthcare stocks leading the way in the U.S., followed by consumer staples. That would include food sellers and food producers. The technology, exactly how we would have suspected it. More software companies, low overhead, e-commerce type names. Maybe one surprise was the financials, although as you see, I note here, I said non-bank. There's a lot more financial technology companies in the US. They did fairly well. And then utilities, a few low risk REITs, and a couple of special industrials that had to do with food transportation. In the TSX, you know, we're a bit more hewers of wood and drawers of water in Canada. We own there's a lot of gold companies in the TSX, so their numbers were well represented. And then as we go through there, utilities, technology, again, software, dominated by software, consumer staples, a couple financials like the TMX Group and Intact, and rounding out a couple REITs and a couple materials. So things are playing out the way we expected them early on in this process. And so I just want to, you know, reiterate and stress what Jason said. There's no risk, you know, there's no rush to jump back into this market. You can have exposure in the equities without taking on a huge amount of risk and participate. And we can wait until we have better and more perfect information before we move farther afield into riskier equities.
Well, thank you so much, Rob, and thank you, Jason. That concludes today's investment strategy update. Stay safe and be well, everyone.